Most people do not realize they are setting themselves up to lose. They believe life is unfair, that the system is rigged, or that wealthy people hold some secret advantage. But the truth is, wealth is not just about what you do, it is about what you avoid. Every day, millions of people make small, avoidable mistakes that keep them financially stuck. Not because they are not working hard enough, not because they do not want a better life, but because they are following habits that practically guarantee they will never escape the cycle. Today, you will discover exactly which financial behaviors separate the people who build wealth from those who stay trapped regardless of how much they earn, why financial mistakes compound just as powerfully as financial wins, and what specific changes break the cycle permanently. Welcome back to Finance Insight in High Def, where we give insight into proven financial principles and how we can use them to improve our daily lives and build towards a better financial future. If you are new here, consider a like and subscribe as we dive into the 8 principles on why these financial habits keep people broke, no matter how hard they work. Principle 1. The credit score trap that makes every purchase more expensive. The first principle is recognizing that your credit score is your financial reputation, and ignoring it means paying a premium for everything the rest of your life. A poor score does not just affect your ability to borrow. It inflates the cost of every major financial decision you make. A bad credit score means higher interest rates on every loan a lender will offer. Banks charge more because they trust you less, and that premium follows you into every transaction. You will pay thousands more over the life of a mortgage than a borrower with strong credit. You will pay double the effective price for a car. Landlords check credit history before handing over keys, which means housing options narrow alongside the score. The corrective steps are straightforward. Pay bills on time, keep credit card utilization low, and avoid unnecessary new credit applications. These 3 actions consistently improve scores over time. Ignoring credit does not feel like a financial mistake in the moment. It just means quietly paying more for everything, while people with stronger scores access the same products at lower cost. Principle 2. The financial illiteracy that keeps you permanently controlled. The second principle shows why not understanding how money works is not merely an inconvenience. It is the most reliable path to staying financially dependent on people and systems that understand it better than you do. If you do not understand how debt works, you will drown in it. If you do not understand investing, you will never build real wealth. If you do not understand how taxes work, you will overpay your entire working life. Financial illiteracy is not only about what you do not know, it is about what you believe to be true that is actually wrong. The wealthy study money the same way professionals study their fields. Warren Buffett has read financial reports and investment literature since his early teens and continues daily. Robert Kiyosaki built the Rich Dad, Poor Dad framework around one observation. Most people are taught to work for money, while the financially literate learn to make money work for them. The gap is not income, it is education. Principle 3. The status spending that destroys wealth before it is built. The third principle reveals why spending to look successful before you actually are is one of the most effective ways to guarantee you never become successful. The habit is almost universal among people who stay broke through multiple income increases. Early success triggers the impulse, the car, the wardrobe, the vacations. This is called rewarding yourself. But the accurate description is spending future wealth before it exists. The people who consistently build wealth delay gratification. They invest first and build assets that generate cash flow. They use that cash flow to upgrade their lifestyle later, after their money is making money. This pattern extends into income growth. When most people receive a raise, they raise their expenses proportionally. New apartment, upgraded car, more expensive habits. The income increased, but so did the spending. The result is the same paycheck-to-paycheck cycle running at a higher number. The wealthy do the opposite. When income rises, investment increases first. Assets can buy the luxuries later. If you spend like you are already rich before you are mathematically prevented from getting there. Principle 4. The single income stream that creates total financial vulnerability. The fourth principle addresses the most dangerous structural position in personal finance, depending entirely on one employer for your financial survival. The wealthy build multiple income streams. Most people have exactly one, and they do not recognize how fragile that makes everything. The problem with a single income is not the amount, it is the concentration. If that one source disappears through a layoff, an industry collapse, a health event, or anything outside your control, your entire financial stability disappears at the same moment. There is no buffer, no alternative, and no time to build one in a crisis. The wealth gap is not only about how much people earn, it is about how many places they earn from. Side income, rental income, investment dividends, digital products, and freelance work are all starting points. A 2024 Bankrate survey found that 36% of Americans with side hustles use them specifically to cover essential expenses after losing or reducing primary income. The strategy does not require a second full-time job. It requires building a second stream before the first one breaks. Principle 5. The health neglect that drains finances faster than any single expense. The fifth principle explains why treating health as optional rather than foundational is one of the most expensive long-term decisions a person makes. Poor health is one of the fastest and most complete ways to destroy financial progress. Medical bills accumulate, work is missed, income disappears. The American Journal of Public Health found that medical issues contribute to approximately 66% of personal bankruptcy filings in the United States. The financial consequence of ignoring health is not theoretical. It is one of the leading drivers of catastrophic financial loss. The wealthy treat health as a compounding investment. They maintain preventive care schedules and address problems before they become crises. Prevention costs less than treatment at every stage, and lost income from serious illness often exceeds medical bills entirely. Principle 6. The waiting mindset that hands control to circumstance. The sixth principle reveals the behavioral pattern that keeps more people financially stagnant than almost any structural factor. The belief that wealth will arrive through luck, inheritance, a lottery win, or a single transformational event rather than through consistent compounding action. Americans spent an estimated $125 billion on lottery tickets in 2024, more than they spent on music, sports tickets, movies, and books combined. The lottery is not a wealth strategy. It is a psychological product that sells the feeling of possibility to people who have not yet committed to building it deliberately. The same mindset appears in people who wait for the right moment, the perfect job, the ideal market conditions, or someone else's permission before acting. Blaming the economy, a boss, or a background changes nothing. The wealthy adapt. They see a difficult environment and look for opportunities within it. They do not wait for external conditions to improve before taking internal action. The moment you stop waiting and start adapting, the direction of your financial life changes. Principle 7. The missing safety net that turns minor problems into financial catastrophes. The seventh principle addresses the structural gap that turns ordinary setbacks into financial disasters. The absence of an emergency fund. Without cash reserves, every unexpected expense becomes a debt event, and debt events compound. A car repair, an unexpected medical bill, or a job loss forces an immediate financial decision. Without savings, the options are credit cards, personal loans, or borrowing from people in your network. Each carries a cost. High-interest debt compounds fast. The cycle that follows, where debt payments consume the income needed to rebuild savings, is genuinely difficult to escape once it starts. Wealthy people maintain cash reserves because emergencies are not exceptional. They are predictable in aggregate, even when unpredictable in timing. Financial advisors consistently recommend 3 to 6 months of living expenses in liquid savings before increasing investment exposure. Without that buffer, every financial plan is one unexpected event away from collapse. Principle 8. The fear of investing that guarantees the same financial position forever. The final principle confronts the belief that keeping money in a savings account is the safe choice. It is not. Inflation consistently erodes the purchasing power of uninvested cash, which means money sitting in a low-yield account loses real value every year without a single bad decision being made. The average annual inflation rate over the past century in the United States has been approximately 3%. A savings account earning 1% annually loses 2% of its real value each year. Over 20 years, that gap compounds into a substantial loss of purchasing power. The risk of not investing is not hypothetical. It is mathematical and ongoing. The wealthy put money into assets, stocks, real estate, private equity, and businesses that grow over time. They do not merely save money. They deploy it into structures that compound. Warren Buffett began investing at 11 years old and has stated that his only regret is not starting earlier. The people who stay in the same financial position year after year are almost uniformly people who treated avoidance of investment risk as financial safety. It is the opposite. If this breakdown of the 8 financial habits that keep people broke has given you insight on the decisions that separate wealth builders from wealth destroyers, share this with anyone still caught in these cycles without recognizing them. Hit the like button and subscribe for more insights that separate those who build financial momentum from those who stay in motion without progress, the financially educated from the financially managed, and the wealth builders from the paycheck-to-paycheck cycle. You may also comment down below on which of these 8 habits you believe has had the greatest impact on your own financial life and what you are doing to change it. See you in the next video.